Learn the latest blockchain developments and explore investment opportunities in the crypto market. Welcome to the new world of crypto. Today we're taking a true recap of human nature, strategy, and money. Not long ago, a token called MYX created a massive wave in Binance futures market. In just 24 hours, its contract trading volume soared to a staggering $8.963 billion. This was accompanied by over $16.22 million in contract liquidations. What a remarkable achievement! This meant that, at the time, its popularity and risk were second only to those of giants Bitcoin and Ethereum. In this capital crunch, some became rich overnight, while others were wiped out instantly. But today, we're not just here for the fun of it. In this in-depth article, we'll dissect two classic real-world cases like a forensic doctor, a winner and a loser. We'll also gain a glimpse into the trading methods of the major players. They faced the same market and the same token, yet their ultimate fates were one heaven and one hell. Was this a matter of luck or a crushing strategic victory? What kind of grievous lessons and enlightenment can this open course, worth tens of millions of dollars, offer ordinary crypto investors like us? Before dissecting the two protagonists, we must first appreciate the sheer frenzy of the battlefield they inhabited. The volatility of MYX's market is more than just dramatic. It's a tsunami. And the epicenter of this tsunami is the perpetual swap market on centralized exchanges. The article mentions a key statistic. At the peak of its price, the funding rate for Binance MYX contracts reached an extreme level of -2% per hour. Let me explain what this -2% means. In the futures market, the funding rate is the fee paid by long and short positions to stabilize prices. Typically, this figure is quite small. But -2% per hour meant that the number of short sellers, those betting on price declines, in the market had reached an extreme. To incentivize those willing to go long, betting on price increases. All short sellers were required to pay a 2% penalty to those who were long every hour. Imagine a casino where the small table is packed. To keep the game going, the casino has a rule. All those betting on small must pay a large sum every hour to those betting on big. Even so, the small table remains packed with die-hard gamblers. This is the true picture of the MYX battlefield at the time. A gamble of the century, driven by greed and fear, with both bulls and bears at war. And it was in the eye of this storm that our two protagonists made their own life-or-death decisions. Let's first look at the winner. The trader in the article has the somewhat awkward name, Knowing White and Guarding Black and White, super high-level trader. Let's call him Hunter. This Hunter-esque record is legendary. Solely through MYX trading, he grew his assets under management, AUM, from 0 to 100,000 USDT in just 7 days. His strategy resembled that of a soldier charging into battle, more like that of a calm, patient, and adaptable hunter. His entire trading process can be clearly divided into 3 phases, which bear a striking resemblance to George Soros's theory of reflexivity. Phase 1. Bottom ambush, August 4th. With MYX's price still hovering between 19 cents and 37 cents and uninterested, this hunter demonstrated remarkable acumen and courage. Without hesitation, he built a massive position, with single positions ranging from 100,000 to 300,000 MYX units. This was no simple bottom fishing. It was a highly certain ambush, based on deep understanding of both project fundamentals and market sentiment. He understood that holding a large position at this stage offered the best risk-reward ratio. This successful ambush gave him ammunition and a psychological advantage for all subsequent operations. Phase 2. Trend following August 5th. When the price entered a period of rapid growth between 48 cents and $1.29, the market became frenzied. At this point, the hunter quickly switched roles. He ceased to be a stubbornly defensive value investor and became a nimble guerrilla fighter. He stopped going long and began to engage in both long and short positions. He went long during the main uptrend and shorted at the peak of local pullbacks, maximizing his profits from the trend. This demonstrated that he wasn't carried away by the market frenzy and maintained a clear distance. Phase 3. High-level trading, August 6th to 7th. When the price surged above $1, even reaching the peak of $2, the entire market had entered a frenzy. At this point, the hunter's strategy evolved again. He became a dancer walking on the edge of a knife. His trading became more frequent, and his positions became smaller. While he did occasionally chase high prices, which resulted in losses, the most crucial point was his risk control was rigorous. The data in the article shows that even though he entered a position at the absolute peak of the $1.92-2.05 range, his largest loss was only 5,765 USDT. And what was his largest profit? 15,681 USDT. Let's do the math. According to the article, this hunter's trading win rate was 61.3%, which is excellent among professional traders. But even more terrifying than his win rate was his profit-loss ratio, a staggering 2.73 to 1. This means that for every 2.73 yuan he earned, he risked a 1 yuan loss. This is the core secret to this hunter's success. Let profits run, but nip losses in the bud. After looking at the winners, let's look at the losers. His name is quite distinctive. Bald using Rejoice One. We'll call him the gambler. His ending was a complete tragedy. Data shows that he lost over 636,000 USDT in 7 days, the vast majority of which came from trading on MYX. His total realized losses on MYX reached a staggering 497,000 USDT. The most ironic thing is that this gambler's trading win rate was a staggering 55.6%. He won more often than he lost. So why did he suffer such devastating losses? Because he perfectly illustrates how a trader is gradually consumed by his inner demons. Greed and luck. Like the hunter, this gambler actually successfully seized the opportunity at the low point on August 5th, between 41 cents and 42 cents, and accumulated profits exceeding 15,000 USDT. However, this success wasn't a blessing to him, but a poison. It greatly inflated his self-confidence, giving him the illusion of market control and setting the stage for his subsequent madness. Later, when the price of MYX soared to around $1.40, the gambler completely lost his rationality. Watching the price soar, fearing missing out on future profits, he made one of the most lethal moves in trading. Chasing the price and doing so with an uncontrolled, martingale-style increase in his position. He made 3 consecutive large-long trades, with his single position reaching a maximum of 265,000 MYX. It was like a gambler, desperate to win, betting all his chips on one last hand. But the market is not an ATM, and the final act of reflexivity will eventually come. When the price reverses, retribution arrives. The data in the article is chilling. The gambler's largest loss was a staggering 265,784.86 USDT. This loss accounted for almost half of his total losses. His largest profit was a mere 10,491 USDT. Let's calculate his profit-loss ratio. A shockingly low 118. What does this mean? He risked an 18 yuan loss for the chance of a 1 yuan profit. This isn't trading. It's suicide. He didn't set any effective stop-loss orders, allowing his losses to snowball until they were ruthlessly swallowed by the market. These 2 vivid examples hold up a mirror, reflecting the truest and cruelest nature of crypto contract trading. This applies not only to the crypto world but also to other markets. The article concludes with a perfect summary. The core of trading isn't the accuracy of your predictions, but your ability to manage risk. Ultimate trading success isn't determined by how much you profit at once, but by how long you can stay in the market. Building on this, I'd like to offer a few more universal reflections for all investors. First, be wary of the sweet trap of copy trading. Both of these cases occurred within the copy trading ecosystem of CEX. For the average trader, copying someone seems like a quick way to make easy money. However, this case demonstrates that when you copy someone, you're not just following their buy and sell points, you're also directly integrating their risk management system into your account. If you follow a hunter, you might be able to share in the profits. But if you follow a gambler, their downfall is your downfall. Outsourcing the most crucial aspect of trading, risk control, to a stranger is inherently risky. Second, win rate is a dangerous drug of deception. The loser's 55.6% win rate is extremely misleading. Many novices obsess over high win rates, but this case, at the cost of hundreds of thousands of dollars, demonstrates that in leverage trading, no matter how high your win rate is, it can't offset a single significant loss without a stop loss. You can win 100 times, but it only takes one loss to leave the table. Your life or death is always determined by your profit-loss ratio, not your win rate. Third, trading is a discipline that defies human nature. The traits of successful traders, calmness, discipline, patience, fear when others are greedy, decisiveness when others are fearful, are almost universally anti-human. The behaviors of unsuccessful traders, chasing rising and falling prices, holding on to losing trades, running for profit, and being swayed by emotions, are entirely human instincts. So what's the final conclusion? In the dark forest of market competition, if you want to be a long-term survivor rather than a fleeting meteor, you don't need to predict where the next 100x bagger will appear. Instead, you need to first establish your own ironclad risk management discipline. This capital should be allocated to a dedicated speculative account, the upper limit of which is the red line of greed. The next time you witness market frenzy, feel incredibly excited, and want to press the all-in button, pause for a minute and reflect on the hunter and gambler we discussed today. Ask yourself, whose behavior am I more like? Because ultimately, the market will neither reward your bravery nor sympathize with your greed. It only respects the rules and rewards those who do the same. The above content is for informational purposes only, not investment advice. Thank you for your company, and see you next time.